When we think of investing, we imagine buying a stock, walking away, and hoping that over the next 5 to 10 years, its value doubles. This chart shows the reality of that approach. For every second of those 5 years, your capital is sitting out in the open, completely exposed to the risk that the bottom suddenly drops out of the broader market. But what if you could sidestep that long-term danger completely? What happens to your market risk if you shrink your exposure time from 5 years down to just 45 seconds? Welcome to the world of the scalper. These high-velocity day traders buy and sell assets in incredibly tight windows, exiting trades in under 90 seconds. They completely ignore those massive multi-year trends. Instead, their objective is to scoop up the tiny, fleeting price movements that most people overlook, often walking away with a profit of just a few cents per share. The entire strategy hinges on one strict golden rule: minimal time exposed to the market equals minimal risk of a sudden crash destroying your capital. Scalping inverts the logic of traditional finance. Rather than trying to predict the long-term direction of the economy, these traders treat time itself as the ultimate risk factor. Of course, making a few pennies on a single trade does not build a retirement fund. The only way this strategy actually generates meaningful returns is through sheer, relentless volume. Imagine a bee collecting nectar. It doesn't look for one giant pool of honey. It visits hundreds of different flowers, extracting a single microscopic drop from each one until the honeycomb is completely full. Scalpers operate the exact same way, executing dozens or even hundreds of rapid-fire microtrades before the closing bell rings. This chart shows daily price action, where one data point represents 24 hours. For high-speed strategies, it's useless. Traders switch to a 1-minute chart. Here, new data generates every 60 seconds, transforming the flat line into jagged spikes, resembling an erratic heart monitor. Zooming into this micro time frame reveals the immediate, wild heartbeat of a stock's minute-by-minute price shifts. To capture micro profits, a trader must completely alter the resolution at which they view the market, ignoring the years to focus exclusively on the seconds. But viewing the price isn't enough. You need to anticipate it. Imagine if you could see behind the scenes at an auction, knowing exactly what everyone was willing to pay before a single paddle was raised. That concept exists in finance. It's called the Level 2 order book, or, as you'll see it labeled on popular Indian trading apps like Kite, Grow, and Dawn, market depth. This diagram illustrates market depth. It provides a live, real-time list of all pending buy and sell orders waiting at various price points. If a massive swarm of buy orders suddenly stacks up against very few sellers, a scalper anticipates an immediate price surge. The reaction is lightning fast. Buy the asset immediately, ride that tiny wave up a few cents, and sell to lock in the profit before the sellers return to push the price back down. By utilizing market depth, these traders aren't predicting the long-term future of a company. They are simply reacting to the immediate physics of supply and demand. While grabbing quick profits from tiny data movements sounds highly efficient, the psychological demands of existing in this state are immense. Processing this hyper-accurate data requires an absolute lock on your screen, intense mental focus, and rapid reflexes. You have to operate with mechanical precision. This graphic shows the brutal math of the strategy. Because the profit margins are microscopic, a single emotional mistake or moment of hesitation can wipe out the gains of 100 successful trades. Strict discipline and rigid capital protection are the absolute most crucial components keeping a scalper afloat. If you let a losing trade run, the system falls apart. Ultimately, scalpers are making a deliberate trade-off. They are actively swapping the anxiety of a long-term market crash for the high-speed stress of perfect minute-by-minute execution. It presents a fascinating financial paradox. For these traders, the safest way to survive a volatile, unpredictable market is to only exist inside it for a few seconds at a time.